Is this year harder than ever to come back from summer vacation and go back to work, to go back into the classroom, to go back into the cubicle, to get back on Zoom sessions? I get it. I do. That's why this week's guest on the Wealth on the Move, the podcast, is so important. I'm going to interview Bob Bernotas from Franchising with Bob, and he's going to talk to us about the opportunities that exist to build wealth in a completely different asset class, not stocks and bonds, not real estate, not art and jewelry, but franchises, and how to get involved with franchises. So if you're looking at that W-2 and thinking, I got to find another way, this is the episode for you to check out. Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. Welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management. And today we're going to get into something that admittedly I don't know much about in the wealth management space. We've worked with folks building portfolios and building wealth in a lot of different ways, whether it's through portfolio growth and asset management. A lot of us are going to work and building our 401ks and building our retirement plans. Folks are building broad real estate portfolios to eventually fund their lifestyles and create some, passive. And if you're not watching us, I'm using the word passive in air quotes because of the friends I have that are in the real estate business. It's far from passive. They're working really hard. But today we're going to talk about another way to build wealth and another way to build a wealth portfolio, and something that I've always been intrigued by but never known much about. We're going to talk about franchising. Today's guest is Bob Bernotas. Bob, did I pronounce that right? I know I asked, but
nailed it. Perfect.
Nailed it. Okay. He is the president of franchisewithbob.com, and he has been a franchise consultant investor for a really long time, about 40 years now. And now he's helping other folks build their franchise portfolios, build their franchise businesses. And I think, Bob, this episode's hitting at a perfect time. Summer is winding down, and a lot of us may have really been enjoying our time on our summer vacations, and it's really hard to think about going back into the cubicle, going back into the office, getting back on the Zoom meetings, and saying there's got to be a better way for me to be building wealth and creating the life that I desire. And I think Bob's going to be able to give us some insight as to how we can do that. So Bob, first off, welcome to Wealth on the Move, the podcast.
Hey, thanks for having me, Will. Great to be here.
I'm excited to get to talk to you about franchising. But before we get too deep into that, can you give us a little bit of history about Bob and how you got into this part of the profession?
Sure. I mean, going way back, my first franchise that I ever got into was December of 1986 when I opened my first West Coast video franchise. If you remember the video industry, and of course, you know where the video industry is today. It taught me a valuable lesson, by the way. And I begged, borrow, and stole to get that first unit open, and fortunately, it did exceptionally well. And opened it in, again, December 86. And that January of 87, it was the top unit in the chain. So it allowed me to move on and open plenty of others across southeastern Pennsylvania. Went up to New York with them as well. But that was my first taste of franchising, and fortunately had success with it. So it continued, and I ended up developing several other brands. I got into a couple of independent businesses as well, several independent businesses. I can tell you I didn't do as well with those as I did with franchise concepts. But that's what got me into it. And it was, the bug bit me, and I loved it. And I just saw the scalability of it. So I stuck with it. And then later I got involved with helping some companies position for growth, franchise companies. And because of my background in franchising, I had a lot of people starting to approach me and ask me, hey, Bob, can you help me find a franchise? Friends of mine, family members, friends of theirs. And so I ended up helping people, and I've taken a lot of time helping people. I'm not making any money doing it. So I decided to monetize it initially. Then I changed the model later, and my approach now is the people that I work with, the candidates that I take on and work with, they don't pay me anything. I'm actually compensated by franchise companies for bringing qualified candidates to them. I'm an independent consultant, so I can theoretically work with any of the 6,000 plus different franchise companies out there. Having said that, I will tell most people that I probably stay away from 75% of them. Don't think they're worthwhile opportunities. Never want to put a candidate in a position where they're simply buying themselves a job, and that's what too many of them are. But out of
Right.
the other, 25, 30%, there's some good ones, there's some better ones, and there's some exceptional ones out there. But got into doing that a while back, but then exclusively I started doing that 9 years ago. This January will be 9 years that I've done it exclusively, and worked with people across the country, across the U.S. and Canada, helping them find, fund, and acquire the right franchise fit.
So for our listeners that aren't familiar, and I'm going to even say for me, not knowing the exact terms, let's start with something very basic. What is a franchise?
Franchise is a system of doing business. Imagine it this way. It's a paint by the numbers system. And this is a wide array of types of franchises, but more importantly, a wide array of the level of support that you get from franchises. And again, there's some good ones and there's some better ones, and then there's a
Sure.
lot that you want to stay away from. But the better companies, they're handing you a business in a box. They've
Okay.
thought of everything. Everything is accounted for. They're going to help you. As an example, if it's real estate based, when I say real estate, brick and mortar retail, you're going into a storefront type location. They will have a real estate department that you will work with to help you find the location, help you negotiate the lease. They're going to help you with the plans for the space. They'll negotiate as much TI money, tenant improvement money from a landlord as possible. They'll have a complete onboarding program for you to get up and running with the brand. You'll be assigned a business coach. That business coach will work with you closely, especially in the first 6 months to a year before you can take off the training wheels. So, I mean, and again, a lot of franchises out there don't offer this, and not good concepts. There's only, I tend to work with a smaller subset of the franchises out there, just so
Okay.
it's a lower risk proposition for the candidates that I work with. And I'll only work with brands if there are certain elements behind them, and you can get involved in that, talking about that if you like.
Okay. So in 1986, when you bought your first franchise, the West Coast Video, what did you think you were buying, and what did you actually get?
Oh, good question. I like that. Well, I didn't know what to expect, honestly. I
Okay.
mean, it was my first foray into the franchise world. I thought I was going to get a concept that was handed to me, and a lot of the things that I just described, and a lot of it was there, but I didn't think I'd get the politics involved in it, and some of the issues that you have to deal with. And this is an example, Will, of becoming part of the wrong franchise organization. And I have no regrets, because I did exceptionally well with it. And in
Right.
fact, I sold it at a reasonable time. I didn't get hurt. A lot of my colleagues stayed in 4 more years, and you know what happened to the industry.
Yeah. Right.
But when I first started, I just followed their script and did what they told me to do. And part of the process was that I have to buy an initial movie inventory. I'm not talking about the new releases that were like anywhere from 60 to $80 when you're buying them directly from the distributors, but you need an initial movie inventory, used movies. And I bought that from them, and they were charging, all the franchisees at that time, $20 to $22 a copy, which, I didn't know, but I found out later after I opened my first store, and then I did a little research. I can buy the same movies, the same used movies, VHS cassettes, for $5 to $7 a
Oh,
copy.
wow.
So yeah, so I wanted to go that route afterwards. They said, no, you can't do that. Like, well, how do you justify charging me this much? And well, we take off the stickers and we check it to make sure it's still good and whatnot. We reject ones that are bad. Like, well, I can't. It's okay if you charge me an extra couple bucks for that. That's one thing. 4 times the
Right.
price, maybe not. So ended up going to war with them over this. Started the legal counsel amongst the franchisees, which later turned into the Owners Association. I was elected president of each, and we went to war with them. We ended up winning the battle ultimately, and we were able to buy movies from where we wanted. Again, that's an example of a franchise company that doesn't have the franchisees' best interest in mind. A
Gotcha.
lot of them do. They shoot straight. They do things the proper way, but it's easy to make a misstep and make a mistake.
So then what, I'm sure there were other franchises after that between 1986 and where you are today.
Yeah.
What made you move from being the owner and owning units to being the advisor to advise buyers? And I'm sure, are you still an owner? Is it still something that you're involved in with
Yeah,
yourself as you're advising other folks?
yeah, I will always be an owner. I'm addicted
Okay.
to franchising. Look, if it's a brand and it's the right circumstance, I'm not going to put time into anything now. I own 6 units of a concept called Game Day Men's Health,
Okay.
and the way that, and it's a longevity brand, very hot category right now. But the way
Sure.
that came about is I was working with a local candidate. I showed him that concept. He fell in love with it. He just didn't have the capital to execute. And since it was local, I liked him as a potential operator and I loved the concept. I said, John, would you want to partner? And he said, yes. And consequently, then I said, why don't we talk about 3? Then I mentioned it to a couple friends at my gym and they said, hey, can we get in on this? And they each put in a little bit of money and all of a sudden we're doing 6 units. So
Okay.
I can find the right situation where I don't have to put my time in it. My total involvement is a 1-hour Zoom call per week. Our
Wow.
manager runs it. He runs it very effectively. He has some skin in the game. So he works his
Okay.
butt off for us, but he's doing everything and we just get on a call with him every once in a while. I don't know if I answered your question. I think I went down a rabbit hole there, but
That's okay.
back on
What made you move from owning units, solely owning units, to advising buyers?
Yeah, I mean, I really enjoy that piece of it. And it really happened by osmosis, like I mentioned a little bit ago. I started working with some companies, helping them position for growth, franchise
Okay.
companies. But then so many people were asking me, about franchising and how do I find the right franchise, that I just started working with a couple people in that regard and helping them. And eventually it just made sense for me to start monetizing this, like I mentioned earlier. And about 9 years ago, like I said, I went entirely into that world where I'm just working with people looking to find, I'm either, people coming from the corporate world, people that
Okay.
are, they're in a job, a well-paying job. They don't want to walk away from that safety net, that job, but they're tired of it. They don't see
Sure.
themselves in it forever. So maybe they're looking for an off ramp in a year or 2 or 3. So you can get positioned potentially with a semi-passive franchise, start building something on the side, anywhere from 5 to 10, maybe 15 hours a week. Initially, it might be less as time goes on, but then position yourself to step away from it. So I started that way, working with a few people. And then I got involved in an organization that I'm involved with now called Franchoice. And the reason I joined this group, and really difficult to get into, everybody's a professional, does this as a profession, and everybody owns
Okay.
franchises that are part of this group as well. But my background fit it really well, and I decided to be part of this group because we have a division, some people in our organization, and their function is to analyze franchise companies, to do a dive into them, to really pre-screen companies. So it took a lot of that burden off my shoulders. So I
Okay.
decided to join this group. So some of those things could be taken care of for me. Then, the rest is history. It started to
Yeah.
take off. And, most of my business, I'd say like half of the people I work with are coming from referrals from other people.
Okay.
And then it just started to replicate.
So you used a phrase there that I want to dig a little deeper into. You said semi-passive.
Yep.
Again, we talked about it with real estate. The folks I see in real estate, it's anything but passive. They're deep in the managing, they're deep in the refurbishing, and then they are, either flipping or renting and moving on to the next unit.
Yep.
When you say semi-passive, beyond the hour commitment,
Mhm.
what else is involved in a semi-passive franchise or semi-passive opportunity?
Typically, and it depends upon, I mean, there's so many levels of semi-passive, and it depends upon the type of brand that you get into, whether it's service, whether it's brick and mortar. But the things that are going to be common with true semi-passive brands, you're managing the manager, the key
Okay.
performance indicators, and the profit and loss. If I were to make a comparison to real estate, I'm in several syndications, so I believe in real estate. That's
Sure.
part of my portfolio as well. So I don't do anything when it comes to that, and that's attractive to me. But if I wanted, a better return on my investment, I may be doing some of the things that you just mentioned, buying and flipping or buying and holding. But everybody that I know that is doing that is spending a lot of time doing it, unless
Sure.
they're hiring a management company to do parts of that, but then they're giving up all their profit in doing so. So to me, real estate is a long play, right? 15, 20 years, you're riding the equity and then you're selling at some point, which again makes sense if you're getting
Right.
into it. But if you're, 55 years old and you're going to get in real estate at that point, I don't know if that makes a heck of a lot of sense. What I can tell you about franchising, if you get into the right franchise, you're going to build equity infinitely faster than you are with real estate. And if you compare the time you might spend if you're buying and flipping or buying and holding and maintaining versus a true semi-passive franchise, it's probably not going to be any more time. It's going
Okay.
to be similar. But to give you an example, I mentioned Game Day Men's Health. I have a 3 to 5 year horizon. If I get into anything, I treat it kind of like real estate in that regard, but it builds
Okay.
equity so much quicker. So my plan is always to acquire something, build it, get a trend line going. So, of the 6 units that we purchased, I don't anticipate having probably 3, maybe 4 open, and then sell everything as a package and command a premium even for the unopened territories simply because I have a trend line on the first 3. So I'm going to build a strong trend line first and position for a sale,
Okay.
for an exit. And I think that's when you're looking at franchises, I think it's absolutely critical that you have an exit strategy. And there's an art form, really a
Well,
science more than an art
it's
form.
so funny you're saying it. Like, this is the same conversation we have with clients about individual stocks
Yeah,
and an entry point, an exit point, and there's going to be multiple conversations in the middle there about, is now the time? Should we change course? All of that. And it sounds like you are looking at a franchise the same way we look at an investment, a stock.
yeah,
Should I buy this? What's the projection? When should I get out of this? How
yeah.
much of it should I own? When should I own more? It sounds like you're taking that similar approach.
I am, and I can tell you that usually when I engage with a candidate, they're not thinking about any exit. It just doesn't typically come to mind when
Sure.
you think about a franchise. You're signing a 10-year franchise agreement. Maybe you're going into a piece of real estate, which is a 10-year lease, but you can always sell it still. It's yours. Being able to position for a sale, I think, is again just so critical. And I look at a 3 to 5 year horizon. Number one, I'm on the wrong side of 60. I don't want to stay in anything too long.
Gotcha.
But I think it's always wise to look at it that way, simply because you don't know what's over the horizon.
Sure.
Something may change. I mean, who foresaw COVID? If something changed, I'm not talking about COVID, but just to any particular brand or the category that it's in, there's some new technology or something changes about it.
Think
You
about
have to constantly
in
be on the guard.
1998 being a Blockbuster franchise owner or something, or West Coast Video, thinking this is never going to end. People are lining up in our parking lot every Friday and Saturday night to pay us to take these
Yeah.
videos out of here. This is never going to end. This is awesome. And now there's what, one left?
Yeah, one Blockbuster. I think it's in Washington State. It's more for nostalgia purposes, but
Yeah,
no, absolutely. And I mean, the writing I thought was clear on the wall on that brand, and I wanted to sell. I mean, I wish I sold probably a little bit sooner, and I would have gotten
sure.
more for it. But I mean, give you an idea of potentially positioning what I'm doing with the one that I bought with Game Day Men's Health. My first unit has been open now for 19 months. My second unit has been open for 9 months, both tracking really well. I'll give you an example on the first unit because it's been open longer. But I mean, it started and we did like maybe 20 some grand the first month. And it's a reoccurring revenue membership based model. Typically, those models are going to sell for more. You're gonna be able to sell them for a higher multiple because it's
Okay.
more predictable, reliable income.
Gotcha.
But each month it has grown, and in month 19 now, we just did 130K last month in revenue at about a 30% profit margin. If you mess with those numbers and say, look, with that type of model, I can sell at a 5 multiple. It's worth. I could probably sell that now for about 2 to 2.25. million. Okay. But by the
Okay.
way, my investment on that first unit, 350. Okay.
Okay.
So that's an example, though, Will, of a unicorn. There's not a lot of things out there that I can show you that perform that way. But if I'm working with a candidate and they say, Bob, show me the unicorns. If someone tells me, and I prefer to work with people that this is their mindset. I want ROI, earnings. I don't give a darn what the widget is, as long as it's ethical, provides a valued service to the community. And most of my candidates are looking for semi-passive. If those are
Okay.
my marching orders, then I attempt to show them unicorns, and some really good things out there. I mean, again,
So I
that's an
want to unpack a little bit here.
example.
Let's go to the opposite side. Every portfolio has a stock that didn't work out.
Yeah.
Let's. I want to hear a story about a franchise that didn't pan out the way that you thought, that not necessarily wasn't a unicorn, but also wasn't something. And I'm sure after 40 years, you've had a couple of those that didn't pan out the way you thought.
Yeah. Well, I didn't, among the franchise companies I get into, I could tell you I didn't have any disasters with that.
Okay.
I'll tell you, the second brand that I got involved with was Hollywood Tans. And that
Okay.
industry has taken a hit as well. And I got
Oh
out
yeah.
long before it really took a hit.
There
Uh,
was, if I remember correctly, well, there was some political intervention there back in the
yeah,
middle
yeah.
2000s, right?
Yeah. A lot of bad press on, potential skin cancer
Sure.
and all that really tamped down that industry. The spray tanning portion of it has continued to grow, but the UV portion of it has not.
Okay.
So that's one that I got into, and some of those things were starting to come to fore, talk about that negative press, but I was still doing really well with it. But where difficulties really arose is, and again, this is an example of a company that didn't necessarily have the best interest in mind for their franchisees. They were like the first one, West Coast Video, they were requiring you to buy the tanning equipment from them. They had their own manufacturing they set up, and their tanning equipment, in my opinion, was not the greatest. It was all stand-up units, not
Oh, okay.
lay-down units. And at the time, at least, people wanted to lay down more so than stand up. So, again, similar situation, kind of went to battle with them. They were a lot more amenable to letting me try different things. And I brought in, lay down units from higher end manufacturers like Ergoline and UWE, and it tended to work a lot better. And then they actually adopted what I was doing and opened that up. That was a little tougher for me. I didn't have the same amount of success with Hollywood Tans. Ended up, bought 11 units in total, opened 5 of them, but then I sold everything to get into another tanning concept that was called Tan World. And I bought actually the franchisor. In this case, I bought controlling interest, 55% of it, and then started to develop that brand and sold my stock in it. Later, it was sold to Suntan City.
Okay.
So I'm not sure if I answered your question, but pull me
Yeah.
back to
So
center line if I.
yeah, one that failed, something that didn't pan out the way that you thought or that hoped.
Yeah, well, Hollywood Tans didn't exactly pan out the way that I hope, and that's why I
Gotcha.
exited that model. And I sold.
Okay.
I was able to sell. Did I make a lot of money on it? No. When I sold those, but I was able to get my money back at
Okay.
least. And by the way, Will, there's also, there's strategies to positioning for sale. And not just in terms of, hey, I want to build something and have this great exit, but also timing is so critical in
Okay.
franchising,
Sure. Yeah.
meaning finding the brands at the right stage of their growth. People often come to me, Bob, I want to get into Crumble Cookie. I want to get into Subway. First of all, you don't want to get into Subway, trust me on that. But something like a Subway or Crumble Cookie, you
Yeah.
can't. It's done. When you start recognizing the brand,
It's
typically
too late.
that means it's too late. It's sold
Yeah.
out. So looking for brands that we can reliably predict are going to sell out in any candidates. So if I'm working specifically with a candidate in a particular market, I want to look at brands that I can predict they're going to sell out in their market, which by extension typically is meaning they're going to sell out predominantly around the United States. Some
Okay.
markets sell out a lot faster than others. And the reason why that's important, because as that brand proliferates in the area, Everything's sold, but it's creating a lot more awareness in the particular market. And with that awareness comes a lot more inquiries to the franchise company saying, hey, this looks really interesting. How do I get one of these? And then they're quickly told, sorry, everything's sold out in this market. However, we have a resale opportunity. So I want to position my candidates to be able to be in that resale position if they step
Gotcha.
forward and want to do that. And not necessarily from the standpoint of, hey, I want to build this for 5 years, 10 years, 20 years and have the straight exit, but also from the standpoint of life events occur. If something occurs and you need to sell your business, I want to put the people I work with in the best possible position to do that.
Gotcha. Thank you for tuning into this episode of Wealth on the Move, the podcast, brought to you by Hoffman Wealth Management. Here at Hoffman Wealth Management, we focus on working with busy families and active retirees, helping them navigate the complicated scenarios of their wealth while building the life that they desire. And we believe that every financial journey deserves direction. That is exactly what our proprietary process, the HWM navigation formula, provides. Just like a GPS, our navigation formula begins with two key questions. Where are you now? What does your financial picture currently look like? And where do you want to go? What goals and dreams do you have? From there, we help you navigate every financial turn en route to your desired destination with clarity and confidence. It's more than a plan. It's a personalized path forward. If you want to learn more on how the navigation formula can work for you, reach out through the contact options in the show notes below. We would love to help you chart your next move. Now, back to this episode of Wealth on the Move, the podcast. Back to the phrase semi-passive for a second.
Sure.
We kicked off the episode talking about folks heading back into their jobs after, maybe a summer vacation or something. Is this something that someone can do while they're executing, a high demanding W-2 job that, and I want you to paint a vision of grandeur here. I want us to, give them the realities of,
sure,
okay, I'm at this W-2, but this is my exit plan. What's that effort going to look like for the next few years before they exit their W-2 job?
I would say in any given year, 70 to 80% of the candidates that I work with are in fact in a W-2 job. And usually they're pretty well paid in that W-2 job. Maybe they have the luxury of working from home, which gives them a little more flexibility. Maybe not. Some of them are working 50, 60 hours a week. Yet they're burning the candle at both ends, but many of them decide, hey, I don't mind burning it a little bit more and getting into a semi-passive brand so I can get out of this job sooner rather than later. And I always advise the people I work with, hey, don't walk away from your job until you can see the franchise is going to be able to replace your income and then potentially scale well past replacing your income. So when you talk about semi-passive brands, and again, it could be brands where you're spending up to 20, 25 hours. I don't really consider those semi-passive. The manager models where they're typically brick and mortar type concepts, and they might start in the 250 range, all in 250, 300, and go up to how many millions would you like to spend. But many of them are going to be in that 250, 300K range up to maybe 750. They're really good concepts. And when I work with somebody, I also help with financing. I work with all the top financing sources to the franchise industry. Typically, the finance sources want to see you put 20% in some cases, even 10% if it's an SBA loan, and you can borrow the rest.
Okay.
But the point is, you'll see with some of these brands, it might be as little as 5 hours a week, a couple hours a week. And you'll see people that develop, 20, 30 locations. Well, they're not spending, a lot of time in each of those locations. So obviously these things can be operated that way.
Okay. So if somebody's sitting there listening to this with the cash between 250 and 750,
not cash.
What's the net? Or not cash. Okay.
Yeah. I mean, if they come to the table with 20%, and let's say we're looking at a brand as 500K. A lot of brands will fall with, that or under. They're coming to the table with 100K. I can help them borrow 400K.
Okay. And they're sitting there saying, what's the next step? I mean, is it credit checks? Is it, take me down the avenue of, okay, I've made the decision. I want to explore this and the capital there.
Right.
what's next?
So typically, I would introduce them to one of the lending groups that I work with. There's two main lending groups that I work with right now because they can take a candidate in a lot of different directions with lending. I mean, we can talk about SBA loan, we can talk about portfolio loans, we can talk about home equity loans, we can talk about, as you and I touched on, the ROBS program or 401k rollover, where you can roll funds out of an IRA or a 401k, if eligible, and there's some caveats to that, into a business without taxation, penalty, or interest. Very,
Yeah.
very attractive way to go.
I think this is going to be one of the places where the lawyers are going to want me to say, make sure you're consulting with your tax advisor before.
No doubt.
Yeah, because I started to read about these ROBS rollovers and these
Yeah.
ROBS funding, and it is intriguing, but it is very nuanced, and it is going to take a specialized
Yeah.
provider or specialized conversation. So you're going to want to make sure that before you just say, okay, I'm going to start this, I'm going to roll the money out of my 401k, you're definitely going to want to have a conversation
No doubt.
with the tax advisor without question.
And I work with some experts who really understand this in very granular detail.
Okay.
And often, when I'm working with candidate, they're not getting it right away. I don't get it 100%. So I'll typically introduce them to one of these entities that can really explain it in fine detail to them.
Okay. Where do you think this fits in to somebody's wealth portfolio? They have their stock accounts, they have their fixed income portion of that portfolio, they have, retirement accounts, they may have some real estate. Does this play like an equity position? Does this play like an income position, or where do
Both.
you see this play in? Okay.
I,
I would agree. That was my what my assumption was. This seems like to me a very high paying dividend stock with greater growth potential than a blue chip.
Yeah. And look, does it increase the risk factor versus something like real estate? Yes. As a whole, if you look at the entire franchise world, yeah. But if you know what brands to look for, and I typically only work with entities, Will, that are that back brands. I mean, there's certain types of entities that are either acquiring brands, brand parents, aggregators, I call them. They'll
Okay.
acquire a brand, and then they have the platform. They put the brand on their platform. They have the platform to provide the capital, the infrastructure to scale, and the franchise expertise. So they'll look for fledgling brands, or it could be a brand that's been around for a little bit, but really hasn't grown. And now one of these companies that has a demonstrated history of building companies successfully and making franchisees successful acquires them and puts them on their platform. I think it's a good place to be. And there's dozens, actually, there's hundreds of those types of companies out there. There's dozens that are good. And the same thing, there's another entity out there called an FSO, a franchise sales organization. And there's dozens and dozens of those types of entities out there. There's, in my opinion, there's 4 that are really good. And so, and those types of organizations help brands grow. They don't own them; they help them grow. They'll take a chunk of their franchise fee up front. They'll take maybe a half a point of their royalty fee on the back end, or maybe 10% ownership. But then they help brands grow. But the better ones are extremely selective with the brands that they bring into their portfolio, and then they're really good at helping them grow. Like as one example, with Game Day Men's Health, the one that I bought, I watched that brand for about a year before I bought it. And I liked what I was seeing. They had a good management team. They had capital behind them. They were putting together the infrastructure to scale. They had just franchised, had a couple of franchises sold, but nothing open yet. When I decided to make the move is when they got into the portfolio. They were accepted by one of the very top FSOs out there. I knew exactly what was going to happen at this point. I knew it was going to grow like wildfire given the category it was in. And the unit economics it was showing in its 6 corporate owned locations. And I still couldn't even move quick enough. My area sold out so damn fast that the only thing was left was tier 3 territories, the territories nobody else wanted to go into.
Okay.
Fortunately, so I had to default 2 hours I'm southeastern PA. I defaulted 2 hours into New Jersey to buy territory there.
Okay.
And fortunately,
so you said you could see, and you could, the signs were there for you? What is that? Just 40 years of experience that's giving you those signs at this point? Or
Yeah, yeah,
okay,
yeah. In a word, yeah. I mean,
okay,
look, the signs that I look for are, where is the brand right now? Does it have the elements in place to grow? Because again, it's timing. And the brands that, if you start hearing about brands, done. So you have to get on the brand at the right time. But the
okay,
risk factor goes up as well when you're doing that, unless you can identify the right elements. And I identified the right elements in that particular brand. And then the final piece was, they just got into the portfolio of one of the top FSOs out there, a company that does not make mistakes with the brands that it brings into its portfolio. They are looking for brands that have capital behind them, strong management team, great unit economics, and they already and they're putting together or have the infrastructure to scale. And they're very selective. They may review a couple hundred brands a year, maybe two or three get into their portfolio. And that one did. And that was the last thing that I was looking for in a great category. That brand existed, longevity. So that's when I was ready to make my move.
gotcha. So, other than the men's health, what other I'm really intrigued to know what other categories you're most interested in right now.
Yeah, general categories, I would say anything in the health and wellness category,
Okay,
especially natural health type things, alternative med type concepts, I think are becoming very, very strong. Longevity things also outside of what Game Day Men's Health does, things like hyperbaric chamber, red light therapy, cold plunge therapy, IV drip therapy, compression therapy. There's a whole slew of things like that that are out there. Some companies are putting a variety of those types of things together. They're becoming popular. It can be a little bit more expensive because it's equipment driven and the equipment's expensive.
right.
But anything in the health and wellness category, I also like the service categories, the trades, the dirty jobs. Those
Okay.
things can be very, very lucrative. Now, I will tell you, somebody's looking for semi-passive. There are those types of companies that are offering a semi-passive model. And semi-passive simply means
When you say
they've,
like an electrician, a plumber, you could get
yeah,
into wow.
yeah, they're franchises for that. And
Okay.
and private equity is buying those up rapidly.
Yeah, no kidding. That's
it, you can get positioned for a potential acquisition if you do, let's say, multiple territories. You scale into them over time, and you have a good size entity. You and private equity, I don't get it. They pay stupid multiples
yeah,
for
I
these,
know.
but private equity is also buying up franchise companies pretty rapidly as well, or
Yeah.
buying into franchise companies. So those are a couple of categories. I will say with those types of the dirty job type ones, most of those they're going to expect you to go into it full time. Some of them have developed a more robust support platform. They do more things for you so you can step into it semi-passive, but semi-passive in those may look like 15, 20 hours a week, not 5 hours a week.
Wow. So, like I said, I was intrigued. For me, the most fun part about doing this podcast is the stuff I get to learn about from guests, because the franchise opportunity has always intrigued me. But I haven't, I've always said if I had more time, instead of doing that, I should be dumping it into my business that I'm running already. And that's where my skill set lies. So I have avoided that, not for any good reason other than my resources should be spent on what I know how to do. And that's why I've
Yeah,
not,
likewise,
but,
likewise. I mean, I
um,
see what you do and the advice that you give in stocks, and I suck at it. I mean, but I'm not having. I mean, as much as the market went up, I'm not having a great year because I don't know when to sell. Mine's just
right.
buy and hold, and recently it hasn't served me well.
What's the most common thing people believe about franchising that's inaccurate, that's wrong?
There's a number of things, but I think that you're buying a job, that they're dictators, that they're going to be telling you what to do. So I've worked with people, especially people that are coming from business ownership. They've been in it, or they've had a taste of it,
Okay.
and like, well, I don't want to be told what to do. I'm so tired of this in my job being micromanaged. That's not what I'm looking for in a franchise. So I think I want to open an independent business. Well, I'll always try to talk them out of that, because I think, I mean, in order to put together everything, if it's a good franchise, what they put together, I mean, it's just a massive, massive undertaking. But the fact that, a lot of people will go into this and think it's going to be a dictatorship, it's not, with the right company. Now, some
Right.
companies, it is that way. but those are the 70-75% that I avoid. But the mentality that a good franchise organization should adopt is your success is our success. We're not going to have success unless we make you successful. This is a partnership. How do we make this work together? Now, that doesn't mean, hey, you do anything you want, and we'll support you in it, because they have to protect the brand. They have to protect the entire franchise system. And I can tell you, franchisees sometimes can come up with some pretty radical things, and things that, like, you really got to turn your head and look at it a little cockeyed, like, how the hell did you really think that would work, or that would be accepted? Just to flat out protect the brand. So those,
because what happens at your game day Men's Health in Charlotte, North Carolina, impacts the impression that folks have in New Jersey.
Sure.
If they have a bad experience, or heard somebody there had a bad experience, that to me is the biggest thing that you would want from your franchise, is
right,
that brand protection, because that's so valuable to you.
Absolutely. And people sometimes can do really stupid things, and I think it's a good idea, but then it not only hurts them, but you're right, it can impact the entire brand.
So if someone's listening to this right now and intrigued but not ready, what's one piece of homework that they should be doing to get themselves ready, or to start analyzing the next step?
Dig up podcasts. There's a lot of good information out there, but I would try to, you can go online and look for franchises and do some research there, but it's a wasteland, honestly. They're showing you what they want you to see, and a lot of it is just not exactly accurate. So I would talk to an advisor. I would try to find somebody who has business ownership experience, or better yet, franchise experience. And it doesn't matter. They could be a franchisee. Maybe they're an executive with a franchise company, and just seek their advice in it. Which direction should I go? How do I, just learn what you can through those types of things. Seek out an advisor that potentially, a consultant versus a broker. And there's a distinct difference between a consultant and a broker. Typically, a broker is going to represent some finite number of franchises, and that's what they can take you to. If you seek out an independent consultant that can give you some guidance, they could potentially take you in any direction. So and
that's what you are, correct? You're an independent consultant.
Okay. Yeah, and then interview them. Find out what their background is. How have they owned franchises? Have they been on the other side of franchising? Ideally, both. Own independent businesses, but just having someone who can give you sound advice, that has been up and down that path before, I think is super important. And there's some really good books out there too. The one that I'd recommend is the E-Myth, or E-Myth Revisited. Great book. Yeah,
both are on my bookshelf. All right, so last thing, where can our listeners find you? How can they follow you? What's your preferred method of contact if somebody wanted to engage?
Sure. Just go to my website. It's franchisewithbob.com. If you want to email me, it's bob@franchisewithbob.com. Megan, my assistant, will get you set up. We can have a 15-minute call just to kind of feel out, does it make sense? Is franchising right for you? Do we want to proceed with it? And if you think it is, and I'm comfortable with whoever it is, then I will schedule a consultation, and we'll talk it out in a more detailed call for an hour, and see where it takes us.
Awesome. Thank you so much for doing this. I hope folks learned as much as I did. Again, it's an avenue that's always intrigued me, but I didn't know much about. And clearly an asset class is that's the best way I would describe it. It's another asset class to think about for your wealth building, for diversification, for getting out of the 9-to-5 cubicle that you may be running ragged of and getting sick and tired of. This is a great thing to think about. Great insight from Bob, and thank you so much for giving this to our listeners.
Hey, been great, Will. Thank you for having me.
Well, thank you for joining this episode of Wealth on the Move, the podcast. As always, you can find me on LinkedIn. I'm very active there. Make sure you check out our brand new website at hoffmanwealth.com. Really cool video that we're really proud of right on the landing page. and a lot of new insights and ways to get in touch with us there. And if you have any questions, you can always reach out to me through email, will@hoffmanwealth.com. But until next time, please remember, keep your wealth moving. Bob Bernotas and Franchise with Bob are not affiliated with Hoffman Wealth Management and Private Advisor Group. Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.